Well, welcome back. It's time now for the Word on Wall Street. Top investors watching your money. Joining me now is 248 Ventures Chief Investment Strategist Lindsey Bell. Also with us is Mitch Roschelle this morning. Great to see you. Welcome back.
Great to be here.
Yeah, thank you for joining the conversation. I want to get your take on markets and the macro story as we look ahead. Futures this morning indicating a decline at the start of trading. Fractional moves pretty much across the board. But of course, this is on top of a loser yesterday as well. All three major indices lower yesterday, led by AI stocks. Another sell-off there. The Nasdaq was down 137. You had Broadcom, Oracle, CoreWeave sliding. Investors worried about all the spending on data centers and this build-out and how ultimately it's going to be financed. Will we see a return on investment here? Meanwhile, the Trump administration unveiling a new U.S. tech force, hiring about 1,000 engineers and specialists to build AI infrastructure and modernize federal systems. The two-year program brings together tech giants like Amazon, Microsoft, Google, and NVIDIA to boost U.S. AI capabilities and compete with China. Lindsey, where do you see tech at this point? How do you want to allocate capital here in the new year?
Yeah, I think tech is still going to be a very important component to the markets in 2026. It's going to be the key driver of earnings in 2026, as well as margin expansion, which is expected to support markets going forward. So I don't think there's talk about is the AI reaching a peak. I think it's just getting started. And the great thing about 2026, I really think, is that this is going to be the year that the AI technology broadens out into the rest of the economy, and it's going to support economic growth across the board.
Which I guess supports the idea that corporate America is going to be spending big on this as well. It's not just the hyperscalers. But I guess the question is, do you look at this AI revolution the way you looked at .com? I mean, because in .com, we had a ton of the hyperscalers like the Amazons of the world and Googles of the world doing really well, and they are still thriving. But there were a lot of companies that were left on the cutting room floor.
Yeah, you know what? I think there's going to be winners and there's going to be losers, but the fundamentals of the hyperscalers, which are the key drivers right now of this growth, they are very healthy. They are still cash flow positive. If you look at revenue growth expectations for the hyperscalers, excluding Meta, 23% cloud revenue growth is expected versus 29% CapEx growth in 2026. So there's a lot of conversation about the CapEx spending not coming through, but I think that it is meeting the demand that is there.
Yeah, well, there's a lot of demand for sure, and expectations that this is sort of a moment in time where it's going to accelerate broader economic growth, Mitch, and I wonder if you agree with that. And by the way, did you see Tesla hit a new all-time high? First time we've seen a new all-time high this year for Tesla. Elon Musk, CEO, confirming that driverless robo-taxi testing is underway in Austin, Texas right now. The company testing vehicles on public roads with no one in the vehicle, a key step toward fully autonomous ride-hailing. Mitch, you think we're actually going to see these things on the road?
Well, I was just in Vegas. I saw the Waymos. They're all over the place. I'm not getting in one of those things.
I don't think I'm going to.
If it's on a track, like in an airport, maybe I'll get in it.
Yeah.
But like if it's just riding on the road. Here's an interesting thing about Tesla. 75% of Tesla's revenue comes from the automobile business that they have. 25% comes from services and energy. Okay. And here's the great thing. Their revenue growth from autos is down 10%. Their revenue growth from services, and I don't know if this driverless car is going to fall into services and they're going to be competing with Uber, is up 23%. Their energy business is up 43% in terms of revenue growth. You have to look at Tesla, not like Ford, not like GM, not like what used to be Chrysler. You have to look at them as a technology company and a completely diversified organization that's solving problems for the next decade and beyond. Their energy business is really a big piece of their business growth, and that's why I think the business is up. The driverless car got attention and maybe moved the markets a little bit, but I think it got people to focus on the stock and realize that fundamentally that company is doing a lot of things.
What about the macro story, Mitch? We're getting some data out this morning. We're getting the highly anticipated jobs numbers, of course, this morning at 8:30 a.m. Let's take a look at interest rates this morning and where the 10-year is, because we've been watching rates go up. Right? We're sitting at 4.1% on the 10-year, and we'll get the November jobs report and the October retail sales report out this morning at 8:30 a.m. Eastern. The jobs report will also include October payroll figures, which were delayed by the government shutdown. Economists expect 50,000 jobs created, with the unemployment rate holding steady at 4.4%. What's your take on the macro story right now?
I think the jobs market is weak. and has a lot of cracks in it. And it's not, we talked about AI, it's not because of AI. I think it's because of corporate overhiring. But this jobs report, the delayed one, the October-November, I think it's going to be stronger than they expect. And we'll find out if I'm right in an hour and a half, because I think all of the holiday jobs were there. Retail sales in stores were up big. And I think that, and I saw, help wanted signs in brick and mortar retailers. I think you're going to see, and hospitality industry was strong, and those are two big job drivers. So I think we're going to see those job reports strong, but that's seasonal work. And I think there are some big weaknesses in the jobs market, and that's why the Fed needs to continue to cut rates.
That's one of the things that I'm worried about, jobs. I mean, I feel like things feel good, but jobs, I'm not sure. What do you think, Lindsey?
Yeah, I think it's at best a stalled jobs market. You're hearing more and more layoffs, and you're seeing less and less hiring, right? And the permanent unemployment rate is becoming a bigger contributor to the overall unemployment rate. So I do think that is going to be something we have to watch going into the new year, because while I'm optimistic about the market in the new year, I am a little bit worried about the consumer. The consumer has been quite resilient. They continue to spend. I think the retail sales number that we're going to get today is going to be good. The question is, can that continue? I think they will get the benefit from lower oil prices. They will get the benefit from tax refunds from the one big beautiful bill early next year. But after that, I think there's going to be some fits and starts, because wage growth for the white-collar worker has really been benign. And
this is what I'm talking about, because the big beautiful bill will have such an impact on supply chains and manufacturing that I think in the year ahead you're going to see new jobs. I mean, in 2026 you'll need more construction workers and more electricians and more plumbers and more people working on what is in that big, beautiful bill. That's why Kevin Hassett always says that the economy is going to be led by productivity in the year ahead. Here he is with me just last month. Watch this.
Because of the really big increase in productivity, I think we could be looking at a 4% productivity increase next year, given how much acceleration there is in AI. Then what happens is that workers are able to produce as much stuff as the firm needs without having to hire a whole bunch of new people. And so we're seeing that recent college graduates are feeling stress right now. But our expectation is that this is something that's going to work out quickly. The AI economy is moving much faster than the dot-com economy of the 90s. And the coaches that AI is producing are going to help make a lot of productive workers a heck of a lot of money. And the bottom line is that we're seeing that real wage growth is really high again this year, after being down $3,000 during the Biden administration. And so all this productivity is putting more money in people's pockets.
So what do you think, Mitch? Because when I say I'm worried about jobs, I'm talking about longer term, the impact of AI. In the year ahead, I think jobs are going to be plentiful. What do you think?
I'm not worried about long term in AI. I think AI is just going to make white collar jobs smarter and more efficient. What I'm worried about is, to the point that Kevin Hassett made, recent college graduates with the right degrees can't find jobs, right? Because those employers, consulting firms, accounting firms, Wall Street, they overhired, and they're just, working through the staff that they have. That's a problem when we have disenfranchised, swaths of people that can't find jobs.
But you're bullish about 26? I'm
bullish about 26. I think I'm bullish about 27, but I do think there's always trouble down the road.
You want to buy stocks going into the new year?
Yeah, I think next year is going to be more cyclically oriented, so industrials, materials, financials. But you got to be in tech, too.
Yeah,
you
all right.
Ignore it.
Lindsey, great to see you. Thank you so much, Lindsey Bell. Mitch, you're with us all morning long. We're so appreciative of that. Stay with us. We'll be right back.